Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing this morning?
I'm doing great. Thank you for having me on, Russ.
Yeah, good to talk to you. This is a big week in the macro world, a ton of data to parse, as well as a lot of earnings coming out. I want to start with we're recording on a Wednesday morning. We just got some GDP data. We've had some jobs data, not all of the jobs data, but I want to get your broad sense of the state of the economy and what it might mean for 10-year yields, over the next 3 to 6 months.
Yeah, it's a great question. So if we're just functioning in a vacuum, and that is we're not looking at what the Treasury is doing itself, we're not looking at what the Fed is going to do later today. So we're recording on a Wednesday here. The Fed announcement is coming later this afternoon. If we're just looking at what the economy itself is doing, what we see is a U.S. economy where the labor market is remaining robust. That is, layoffs are not picking up, and growth has rebounded from a first quarter, which was fairly weak. We'll call it a negative print in the first quarter to about a 3% growth pace in the second quarter. And that's a surprise because most analysts, ourselves included, did expect that the second quarter was going to show an economic slowdown, at least a continuation of the first quarter weakness because of the uncertainty brought on by tariffs, but also because of a seasonal slowdown that we see in that middle portion of the year, late first quarter, early second quarter. So we all expected that there was going to be a slower pace of growth in this second quarter. And that just hasn't materialized. In fact, you've seen what appears to be on paper a reacceleration of growth. And so, as a consequence of that, if we just look at the economic data, strong labor market, real growth coming in around 3%, and inflation still above the Fed's 2% target and seemingly moving a little bit higher, then you'd expect to see 10-year yields making a fairly strong move towards 5%, or at least that 480 level that we peaked at earlier this year. And we're not seeing that this morning. And that's because there's other factors at play, namely what the Treasury announced this morning in terms of its funding plans for the next quarter and beyond, and also because the market wants to see what the Fed is going to do later today when it comes to interest rate cuts or the outlook for cuts later this year.
Well, let's talk a little bit about that Treasury refunding. It's kind of an esoteric corner of the market, but something you spend a lot of time looking at. Put it in layman's terms, why this announcement is important, kind of how it sets the stage for the rest of the year. And then one question that we do see a lot or kind of, gets battered around a lot is whether foreign demand for treasuries is pulling back. And if that's having an impact as the U.S. kind of isolates itself a bit more with economic policy. Are we actually seeing any evidence of that? And what's the impact on yields?
Yeah. So on the first question, what is the Treasury refunding announcement and what's been released this morning? Essentially, the problem that the Treasury faces is there's a lot of information out there as to how big the deficit's going to be from the tax bill that was just passed earlier this year. A lot of misinformation out there, but what we can all agree on is that the deficit is not likely to shrink. And if it does shrink, it's going to be marginal over the next 12 and 24 months. That is, we're still looking at deficits that are going to exceed $1 trillion per year the next 2 years, if not more. And that's the baseline. And so that means that we'll call it somewhere between 2 to 4 trillion of new debt is going to need to be financed somewhere. Now, the question is going to really come down to, are they going to finance it with short duration borrowings called T-bills, or are they going to eventually finance this with longer duration borrowing? And so today's announcement really just continues to stick with the strategy that was put in place by the prior administration to fund that deficit with a majority of Treasury bills, short duration borrowing. And so that means there's a reprieve on the back end of the curve, the 10-year to 30-year portion of the curve, where supply is still not going to be rising based on versus current auctions. So for example, 10-year auctions are about 40 billion or so a month, and that's going to stay in place, as the Treasury said this morning, at least for the next few quarters, and really, which means they're not making any plans yet to raise that. Now that feeds into the question of, is there demand, particularly from foreign buyers for treasuries at current levels? Absolutely. 10-year auctions, 40 billion per month. That may seem like a lot, but that's easily digestible by this market. Certainly at current levels, and foreign investors will still continue to find value there. But when you start to raise those auctions, let's say a billion, 2 billion, 3 billion a month going forward, at some point in time, you're going to reach a point where, again, foreign buyers are going to pull back until prices or valuations cheapen and interest rates rise. And the Treasury doesn't want to see that happen just yet. So make a long story short, the Treasury announced today that it's going to continue to increase or ramp up its T-bill issuance to put less pressure on the long portion of the curve. And because the Treasury knows that there is ample demand for short duration borrowings as of right now. And that's an important point because the Treasury, as well as most outside onlookers, expect that that demand for short duration bills is going to be quite abundant for years to come. And so no surprise that they're continuing to raise their bill auctions and foregoing or delaying increasing their longer duration coupon auctions.
Yeah, absolutely. And keeping interest costs relatively lower at the same time. Tom, this has been really insightful, a good look at a broad swath of the fixed income market. We appreciate the time as always and look forward to talking to you again soon.
Thank you, Ross.